Okay, guys, so here's how we're going to profit off of the foreign exchange market. Okay, so we're an international investor who we expect that in the future, the British pound will buy $1.6 in U.S. currency instead of the current exchange rate, which is $1.50. We may hope for the following chain of events to occur. So basically, what's going to happen, right, is we're going to take $24,000 in U.S. currency, and we're going to go to the foreign exchange market, and we're going to get 16,000 pounds. Okay? All we did there was we did the exchange rate of where 1 pound is $1.60. Okay? So, and we found the currency to where $24,000 is the same as 16,000 pounds. Now, we're hoping to do this, right? We're hoping to the exchange rate for British pounds changes from $1.50 to $1.60. So here's what's happening. Okay, the exchange rate changed to where now, if we were to convert it back, we can now get 25,600. Okay, so basically, here's how it goes. You had $24,000. Okay, and with the current exchange rate of $1.50 for 1 pound. Alright, and then we had $24,000. We don't know how many pounds that is, so we do the handy dandy butterfly method. So then we'll do 24,000 equals $1.50. X will divide by $1.50. And so X equals 24 divided by 1.5, and that gives us 16,000 pounds. So this is very important. We started with 24,000. We're now in, British pounds, so 16,000 pounds. And now we're waiting. Okay, so we have 16,000 pounds and we're waiting. We're waiting for this to happen. We're waiting for the exchange rate to change to 1.6. Because now we have 16,000 pounds and we want to know how many dollars can we get. Well, we do know that 1 pound is $1.6. So we'll do the exchange rate here. We'll multiply 16,000 times 1.6, and this equals X, and so that would equal 25,600. So that means that we bought currency for 24,000, right? And then through the exchange rate, because the exchange rate changed, we got $25,600. So that means our profit is going to be $1,600. Congratulations. You did absolutely nothing other than wait for the exchange rate to change. And as soon as it changed, you bought it back to where you were able to profit. You were able to turn $24,000 into $25,600 like magic. Okay? Now, what if it were to go the other way? Like you do the same thing, right? Where you're trying to maybe expect something to happen, but let's figure out what happens here. So now we are an international investor who expects in the future a British pound will only buy $1.40. Okay, so now we're thinking that the exchange rate is actually going down. So instead of the current exchange rate of $1.50, we want it to go to $1.40. So here's how it goes. We take 20,000 pounds, we convert it to $30,000 through the exchange rate, and now we're waiting for the exchange rate to go to $1.40. So now what we'll do is we'll convert it back from dollars to pounds. And sure enough, we turned 20,000 pounds into 21,000 pounds. So this is going the other way. Okay. So this is how the British pound could make you profit if the exchange rate changed. Okay. So notice here that when the dollar goes from $1.50 to $1.60, that's where you earn more profits for the dollar. But when the dollar goes from $1.50 to $1.40, that's where you're actually profiting for the British pound. So this change in the exchange rate is what we're going to call strengthening or weakening the currency. Basically, it's either appreciating or depreciating. When the exchange rate for a currency rises, so basically from $1.50 to $1.60, then this currency is worth more in terms of another currency. So basically, when the British pound goes from $1.50 to $1.60, this means the British pound is appreciating, because you're able to buy more dollars with the pound. When the currency is depreciating, this is when the exchange rate for the currency falls so that a currency is worth less in terms of the other currency. So this is where it's actually going the other way. Okay. So as you can see here, when one currency appreciates and the other depreciates, they closely move with one another. So basically right here, whenever this is going down, we also experience times when it's increasing. Alright, so they are pretty closely related if we're talking about the Canadian dollar and the US dollar. So they move in opposite directions. One appreciates, the other depreciates. That's what we're going to find here. Okay. So that's the key terms here, is when we're appreciating or depreciating. Appreciating is where your dollar or your currency is getting stronger, meaning you can buy more of the foreign currency. And then there's depreciating, where you can actually buy less of the currency. Okay. So what does that mean for the following situations? Like, what do we want? Well, it depends on where you are. Do you want a stronger dollar or a weaker dollar? So basically, if you have a stronger dollar, this means you can buy more of the foreign currency. So now that you have more of the foreign currency, you can buy more foreign goods. So therefore, the U.S. exporting firm, right, would be saying, no, we don't want a stronger dollar. Because if the dollar is stronger, you can buy more foreign goods. So that's actually imports. A foreign firm exporting to the U.S., right? So U.S. is buying imports. So that's a happy face for a stronger dollar. Because the foreign firms are like, oh, yes, right? Your dollar's stronger, buy our stuff, okay? But the U.S. exporting firm, they like a weaker dollar. Because a weaker dollar means that their currency is stronger, meaning they can buy more U.S. goods. And if they can buy more as U.S. goods, that's more exports. How about a U.S. tourist traveling abroad? Well, if I'm traveling abroad, I want to be able to buy more stuff. And the only reason I can buy more stuff is because my dollar is stronger. Okay? So if I have a stronger US dollar, I'm going to be happy as a tourist. However, I'm going to be happier if I was a foreign tourist in the US if I had a weaker dollar. Because if I have a weaker dollar, I have a stronger foreign currency. So if I was in Mexico visiting the US, okay, and I had and I was trying to figure out, okay, when should I go to the U.S.? I should go when the peso is stronger, so I could have more buying power in the U.S. For a U.S. foreign investor, okay, you're investing into the U.S. investor is investing in another country. The only reason you invest in another country is because you can buy more investments over there. So you would like to have a stronger U.S. dollar, so you can buy more of the foreign investment. Versus the, I flipped those around. Sorry. So the foreign investor is wanting a stronger dollar, because what that means is that that's actually going to change the interest rates. And we'll talk about what that means in a second. But basically, when a U.S. investor is trying to invest abroad, it's actually better if they have a weaker dollar. And a foreign investor investing in the U.S. would actually like a stronger dollar. So basically, because the dollar is stronger, that's going to change the amount of, basically it goes back to the balance of payments and the flows of the currency and the flows of capital. So let's take a look at these a little bit more in depth. This is the foreign exchange market where we have a demand and supply. This is what's going to be creating the stronger or the weaker dollar. Okay, appreciating or depreciating. This is where it happens. Demand and supply. Okay, so what happens here is we have the quantity of the currency, such as the dollar or the peso, and the price of it, right, is how much you can exchange it for. So the quantity of US dollars traded for pesos. So we need to look at the price of the pesos per dollar. How many pesos can $1 buy you? So that's what we're trying to look at. So that is the price. So instead of price and quantity for supply and demand, we are looking at the exchange rate and the quantity. So one reason that to demand a currency on the foreign exchange market is the belief that the currency's value is about to increase. So you're going to demand the dollar only because you are trying to buy more foreign goods. And the only reason that you are trying to buy foreign goods is because you want to have a stronger dollar. So one reason to demand a currency is because you think it's going to get stronger, so increase, right? That's when you're demanding a currency, is when it's stronger, it's like, okay, now I want to buy it because now my dollar is stronger, therefore I can buy more foreign goods. One reason to supply the currency is the expectation that the currency's value is about to decline. So basically, when we looked at this one and we saw this decline, right, that is where we want to supply, because then we can profit off of that. So the one reason we would supply the currency is we think the value is going to decline. For example, imagine that a lending business magazine like the Wall Street Journal runs an article predicting that the Mexican peso will appreciate in value. So basically it hasn't happened, but this article says that this will happen. So nothing's happened yet, but we put out this expectation that the Mexican peso will appreciate. So what's going to happen here is this is going to affect the demand and the supply. So basically what's going to happen here is that because the Mexican peso is going to appreciate, this means that you would rather try to sell some of your dollars to get the peso because it's going to be stronger, and that's going to affect the demand and supply of the peso. Another reason that you would look at the foreign exchange market is for investments. The motivation for investment, whether domestic or foreign, is to earn a rate of return. If the rates of return in a country are relatively high, then that country will tend to attract funds from abroad. So basically, if you were trying to save money, right, would you rather save at 1% or 5%? You'd rather save at 5%. So if you're trying to look at two different countries, and one pays 1% and one pays 5%, you'd rather save with the one that pays 5%. And so what happens here is you want to invest in this country, you need this currency. Whatever it may be, you're going to need this currency in order to do it. So basically, you're going to demand that currency by supplying your currency. Conversely, if the rates of return in a country are relatively low, then funds will flee to other economies. So if the interest rate in the U.S. declines, people in the U.S. are going to want to invest somewhere else. So you want to go wherever the interest rate is higher. Changes in the expected rate of return will shift the demand and supply for a currency. Something else that could change the exchange rates would be a change in price levels. So as a consumer, you want to buy the cheaper price. So wherever it is cheaper, that is where you buy it. So when the prices in a country are relatively more expensive, you buy from other countries. So basically what's happening here is, like, let's say for the US, okay, their prices are higher. Maybe because aggregate demand is higher, this increases price level. So prices are higher in the US. Now, this means it's cheaper to buy from other countries. So you're going to demand from the other countries. This demands the dollar. And so this rise in the domestic price level makes foreign goods more attractive. Okay? But what happens here is you're demanding more of the foreign currency, right? So what happens to the value of that currency? If you're demanding more of that currency becomes stronger. And what can they do with the stronger foreign currency is they can buy more US goods. So basically what's happening here is because you're buying more imports, foreign countries could buy more exports from the US. And what do we know about exports? Exports are going to increase aggregate demand. So if aggregate demand goes higher, then we're going to have a big problem with inflation, because inflation's already too high. But if we have more exports, this is going to increase the inflation even more. So the central bank is going to need to step in here and make sure that this is a good, is everything good here. We don't want inflation to get out of control. The other thing is about changes in income. A rise in the domestic income does increase the demand for all goods, both domestic and foreign. If I had more money, I'd buy more of what I'm already buying, and I could buy from foreign countries as well. So the supply of the domestic currency increases in order to purchase these imports. Basically what's happening here is if I wanted to buy or demand a foreign currency, right, I need to supply the dollar. So the domestic currency depreciates because I'm supplying it and making it weaker. So the last thing we're going to talk about is this purchasing power parity. So through the whole process of what we talked about, where like profiting off of the foreign exchange market, we also have this thing called arbitrage, the process of buying a good and selling goods across borders to take advantage of international price differences. So basically the same car, you can buy in the US or Canada, is worth, or I'm sorry, you can buy the same car in the US or in Europe, same car. So in the US it's worth 20,000, but in Europe it's worth 18,000 euros. Same car, so you're like, okay, this is relatively the same price. If the price of the car ends up being less than 18,000 euros because of the exchange rate, then you would exchange dollars for euros and buy the car in Europe. Okay, so basically what's happening here is you have a car in the US that says $20,000, okay, and you look on the exchange rate website and you say, okay, $20,000, that equals 18,000 euros, okay, and then all of a sudden you look back next week, okay, and the exchange rate is the same, but that car in Europe is now 16,000 euros. So what you do is you will exchange your money in euros and buy the car in Europe, and now you got the same car for a cheaper price because the car is less than the 18,000 euros, even though it's the same car. So this is what we call arbitrage, where basically there is an opportunity to make profits, right? Because you can buy the car for, let's say, 16,000 euros, get it back, exchange it to where now you can sell the car for $20,000 in the US. So you're going to win here. You're going to have a profit. And so that's what arbitrage is. The process of buying or selling goods across borders to take advantage of the international price differences. Okay. Now, over time, this is not going to happen because eventually prices increase and decrease. Prices become at equilibrium much faster these days, to where if there was an arbitrage opportunity, it would quickly change back. So these are very, very rare opportunities. We also have a thing called purchasing power parity. So this is where the exchange rate equalizes the price of internationally traded goods across countries. It serves two functions. For international comparison of GDP, of other statistics, and the exchange rate will often get closer as time passes along. So the purchasing power parity is just basically, look, if we're trying to buy the same stuff, we want it to be to where the price of that stuff is similar to the exchange rate. So if I had $1, okay, I can buy $1 worth of fries, okay? But if I go to Europe and I try to exchange my dollar for $1.50 euros, like 1.5 euros, can I buy the same fries? That's what purchasing power parity is all about. So for example, okay, there is a thing with the Big Mac purchasing power parity, because the Big Mac is pretty much the same everywhere, right? So we kind of have an idea of the cost of that. So it's the same good. We can look at the cost changes there, and we can also look at the change in the exchange rate. So the Big Mac index is actually pretty fun. But anyways, the Big Mac costs 4.19 pounds in Britain, and it costs 5.58 in the US. So looking at this exchange rate right here, so basically 5.58 and 4.19, if you were to put this into an exchange rate, then $1 is equal to, you gotta do X here, so 5.58X is equal to 4.19, so X is equal to 0.75. So using just the prices of the Big Macs, the exchange rate should be 0.75. So now let's look at what the actual exchange rate is. Now, the actual exchange rate is 0.78. So basically this suggests that the British pound is 3.4% undervalued. It should be worth more according to the exchange rate, 0.78. But in terms of the Big Mac index, we're actually undervaluing the euro. Like, the value of this Big Mac should be higher. It should be closer to 4.4 British pounds, but it's only worth 4.19. Okay, so that's how the purchasing power parity works. Is basically you look at the same goods and what you can buy, and then you look at the exchange rate and are they matching up. Okay, over time, hopefully this equalizes to where you look at the exchange rate, the actual exchange rate, 0.78, and then you look at the Big Mac index, and sure enough, it's 0.78. So this means, it's the same for goods. So that's what the purchasing power parity is all about. In the next video, we'll talk about macroeconomics and the exchange rate. I'll see you there.